Hi, my name is Gontse Tsatsi, Head of Retail Client Management at Old Mutual Investment Group, and I'm joined by Portfolio Manager Urvesh Desai. We're going to be talking equities. Global equities are an investment category that receives a lot of support in the local industry. This has been the case for a number of years. Urvesh, what is the role of equities in a portfolio? And taking it a step further, what is the role of global equities in a portfolio, and what is the optimal allocation?
If there's one lesson to take out of long-term perspectives, it's that inflation is the biggest enemy of investors, eroding their wealth over time. The role of equities is very important in the fight against this. It's the best solution to growing your wealth in real terms. That means getting returns over and above inflation. We have the South African equity market that has a host of South African companies listed there, but there's also globally a host of different industries and different economies that one can get exposure to by investing in global equities. Now, these economies may be growing faster, like some of the ASEAN or Asian emerging market countries, or they could be growing slower, like Europe, for instance. But importantly, what they also have is industries that are not available locally. Newer industries like tech hardware, semiconductor manufacturing, also old industries like auto manufacturers. So exposing yourself to these different economies that are moving at different paces, exposing yourself to different industries, new and growing industries, gives you different return patterns to what you can acquire in the local market. By blending these together in a solution, what you then get is the benefit of diversification, and this gives you a smoother outcome. So you're not putting all your eggs in one country or all your eggs in a particular industry or sector. Recently, there was a significant change to the regulations governing how much we can invest globally. These changed from a maximum of 30% to a maximum of 45%. This is quite a significant change to the regulations and gives investors a whole lot more flexibility in how they can invest. This flexibility can be harmful in a way. It all depends on what you're trying to achieve with your investments. So global equity can be seen as quite a sexy asset class in that it has all the brands and the names that people know and care about, and also is seen as a bit of a higher returning asset class. But another lesson from long-term perspectives is that actually South African equities have given you higher real returns than global equities. However, the important part about including global equity in your solution is the diversification benefit it brings. Now, when we're trying to come up with what's the best amount of global equity and global assets to have in our portfolios, the work that we've done focusing on the past history of returns in many, many years and many, many portfolios, what it tells us is that the optimal allocation for global assets is actually not at 45%. It's well below this. And in fact, it depends on what you're trying to achieve with your portfolio. If you're trying to preserve capital and you're a bit more cautious, remember you're preserving capital in rands. When you invest offshore, if you have a rand strengthening environment, that's going to detract from global returns, and therefore it's going to harm your chances of preserving capital in rands. However, investing offshore does give you the benefit of when the rand weakens, it boosts your returns, so it helps you out in these circumstances. So some global is good, but not a lot. And that's what we try to do with our solutions. Not only take into account the long-term perspectives that we bring from history, but also put that into the context of what are the forward-looking returns we can expect, and therefore invest optimally for your portfolios.